Hi traders, it's Zoran Kresovic here from Eightcap, and another trade week here upon us. Quite a busy one, a lot of news going around. So how about we actually get stuck into it quite quickly? I'm looking at the economic calendar for this week. Obviously, we're halfway through the week. Quite a bit of news coming out today out of Australia. CPI data, Reserve Bank of New Zealand as well, left rates unchanged at 5.5%. But how about we actually focus on what's coming up tomorrow, Thursday and Friday as well. So I'll actually click on the high impact news for now. And the key news that's actually coming out later this week or on Friday out of US is the core personal consumption expenditure. The favorite gold for Fed in terms of the interest rate decisions. So no doubt there will be highlight event, but also most likely probably move the markets quite a bit. So if you have a look at the actual numbers itself, the forecast is coming at 0.2% and prior at 0.3%. So we expect CPE expenditure index to actually come in lower than what it was for the previous month as well. If you have a look on yearly basis as well, we can actually see the forecast at 3.5% as well, with the previous year on year being 3.7%, indicating that inflation is being subdued and easing off in the US. And no wonder Fed is considering or talking about coming to the end of the rate cycle and perhaps looking ahead and focusing more on when they will actually start cutting the rates. At the moment, market is actually pricing 85 basis points to be cut in 2024, most likely coming through from June the 1st up until December 2024. Today, I will be focusing on a couple of things. The major currency pair that I'll be looking at is gold, XAUUSD. But before we actually get stuck into it, I do want to show you the current sentiment in the market in terms of the volatility. And we can actually see the volatility index is hitting some major low levels. At the moment, it's actually sitting around 13.77. And if you go back in history, we can see those levels being breached back in July 2019. So in terms of the actual volatility itself, the reason upon too much volatility going on in the market at all, however, there is some particular asset classes and instruments that are actually moving really well. Let's get stuck into it. First thing I want to actually show you and go through very quickly is obviously Aussie index at the moment, AUD versus all the major pairs. And as you can see, from the time that it peaked in October 2023 all the way down, it's dropped approximately 4.47%. So we're actually going into a short and medium term downtrend on US dollar index. And it's likely that we will breach that 50% and 61.8% Fibonacci level of that range from the lows on 17th of July up all the way to the actual highs on 2nd of October. So if it does break these levels and the PC expenditure index comes in lower than what market is anticipating, we can see inflation cooling off, and we talk about soft landing because Fed has been talking about it quite a bit, then it's highly likely the market is not going to price any more interest rates rises in the US, and it's likely that we will most likely see dollar index continue its downward trajectory, most likely moving within the range of around $100, which is a big support level, has provided so back in May 2023 and also in January 2023 as well. That's probably where we're heading to in terms of the US dollar. We can actually have a look at the 30-year treasury yields as well and 10 years. So end of the stick in terms of the yield curve, we can actually see on 23rd of October, we peaked approximately at around 5.27%, and we're actually moving in a downward range as well on that too. So what that's telling us is that long yields or 10-year treasury yields at the moment are not also pricing any more interest rate rises, and therefore it's actually coming off, indicating that over the next 6 months or so, we will actually start seeing interest rate cuts in the US. And obviously at such result, with yields coming off, bond prices going up and US dollar coming off, it seems to be that we've got a risk on sentiment at the moment. On the back of that, talking about risk on sentiment, we can see all equities across the globe, NASDAQ, S&P 500, DAX, FTSE, Aussie 200, they're all actually performing quite well and moving in a nice uptrend at the moment. But the pair that I want to put a lot of focus on today is gold. So the reason why I would like to actually focus on gold at the moment is for a number of reasons. Number one, it's actually just about to reach an all-time high, or it's actually a few points, 1.1% of all-time high. And many are questioning why is gold going off, because it's generally considered as a hedge against the risk. So when there is a lot of uncertainty across the globe, when the volatility index is is running quite high and elevated volumes are happening in the market and a lot of uncertainty, as I mentioned previously, we generally see gold and silver perform quite well. But it seems like the general shift in the market or, towards moving into 2024 is actually changing quite a bit. And therefore, we are seeing gold and silver do quite well in line with the risk on assets as well, like I mentioned previously, like equities as well as cryptos. There is a couple of reasons for that. Number one, gold is being considered as a hedge, and given the fact the US dollar is actually starting to come off and yields to 10 in particular and 30-year treasury yields are coming off, which means that investors are not getting enough money for their work at this point in time, and therefore it is considered that in 2024 there is a talk about recession, there is a talk about unemployment going up, and as a result a lot of governments, a lot of institutions, a lot of investors, a lot of hedge funds and asset managers are actually looking more towards that safety hedge. So if you have a look at this chart at the moment here, we can see that gold is actually just about to reach that major resistance level at around 2075. And if you go back into history does not repeat by rhymes itself. We can actually see that resistance or that major peak was created back in August 2020, followed by 7th of March 2022. And then we had that triple top occur on May 2023. Now, many would say, is this the time where gold is actually going to reach that point again and get sold off? I am generally of a slightly different view on that one at the moment with many analysts, because I do currently believe that whilst we might get in the short term bit of a resistance and pullback on gold, still medium to long term moving into 2024, it's highly likely there will be quite a bit of demand for gold. There is a number of reasons for that. If you purely focus on the chart itself, as I mentioned previously, we can see that we are only 1.18% of the major peak. Something that we need to actually consider and take into account here is as well what is considered as a short-term bar analysis. So if you have a look at it back in 2020 August, we can actually see the length of the bars, the buy and the sell. It was actually dominated by buyers and trying to buy enough gold to actually sustain the COVID and all the difficulties or challenges at that point in time. But the next bar after that in August, the month of August, was quite bearish as well. Now, if you have a look at the focus on 7th of March 2022, we can actually see that whilst we did reach that major peak of $2,075, there was not enough buyers in the market and there was not enough conviction in the market. And as a result, we can actually see that long bar was mainly dominated by sellers, because whilst they actually opened at $1,973, it also closed at $1,983, despite the fact that the actual price went all the way up to $1,075. After both of these instances, we've actually seen a significant sell-offs here, major trough occurring back on March 2021, and then a lower trough occurring in the month of October 2022. So many would actually say, what is different right now as opposed to at that period in time? Well, if you have a look at the actual month or price in May 2023, we can actually see the price reached at $2,075 and it actually sold off. However, if you compare that to the previous two sell-offs, we can actually see that the sell-off itself was much smaller and shorter in price and also in period of time, which is quite significant. Why? Because that indicates that whilst the sell-off did occur and there was a lot of short selling at that point in time, it seems the buyers were actually loading at the lower prices and therefore anticipating the discounted price on gold to actually load and find the support level around $1,800, which has provided back in history as well. So if you take out the low in 31st of October 2022, and we actually take the peak on May 2023, if we apply the Fibonacci level to see how much potential downside could occur before gold finds support or buyers coming in and buying at discounted prices, it was actually spot on between 61.8 and 50% of that range. What that indicates and when it coincides with the natural level of support around $1,800, well, that actually clearly demonstrates that there was quite a lot of buying in play. If we also apply the long-term downtrend line at that point in time, we can see the long bar that's coming into the effect in the month of October or week of October ending on 9th of October. We can actually see the buyers have come in strongly and dominated the market despite the fact the price got sold off heavily in the week of 25th of September and 2nd of October. So the price has actually broken that. It created a peak in the week of 23rd of October. It has done actually a pullback, and basically, once again, price was dominated by buyers. And we can actually see that the last 3 weeks have been heavily skewed and dominated by buyers in the market. So if we compare the actual length of the bars on weekly basis, and we can actually see the opens on the lows and closes on the highs, it only demonstrates that buyers are in full control at this point in time. If we see this trajectory continue to unfold and we see weaker data coming out of the US, if we see the long end of the yield curve coming off as well as the US dollar index, then we are likely to see gold continue to come up and challenge that $2,075. If we see a close or strong weekly close above those levels, or in fact, actually, if you're more of a long-term investor and we see a strong monthly close above those levels, then it is actually likely that the gold will continue to go up and create a new time high. In saying that, obviously, if gold was to create the all-time high and have a strong close above 2075, that is generally considered as a bullish move and likely that the price will continue to rise. How do we project the next levels? Well, there is a number of factors that we can take into account. We can actually do the price extension levels and different indicators as well to take into consideration. However, it is not to say that the price could touch that 2075 and start coming off. If that happens, it is only natural because, big institutions, big hedge funds actually like to have a look at the levels around key support and resistance. And therefore, the price of $2,075 has provided that for a number of years, back since 2020 more recently, and therefore we could see a bit of a pullback and some profit taking. If that happens, it is likely that we could get the price to actually drop to around $2,000. 2,000 is a nice round number, and that could provide the first level of support. Any strong sell-off around those levels, it's likely that we could go all the way back down to that $1,800. However, I'm more skewed towards the bullish side at this point in time as opposed to bearish. All the setups and everything, higher peaks, higher troughs, it's broken through 200-day exponential moving average. RSI, 14-day RSI does not indicate overbought territory at this point in time yet. However, it will do so shortly. In the meantime, we're going to follow the trend. It looks bullish at the moment, so we are approaching those key levels, something for traders and investors to pay close attention to. But obviously, it comes down to your trading style and generally the risk reward ratio that comes into play. I hope you really enjoyed this session, more of an educational one for you guys. If you have any questions or any feedback, please feel free to comment on our YouTube channel or give me a follow up on Twitter. I'd be more than happy to look at any other currency pairs or any other instruments that you wish or would like me to actually take into consideration for the next week. Thank you and enjoy your trading. Take care.